So just quick intros for ourselves. Actually, Kyle, you wanna kick it off with an intro of yourself?
Sure. We'll share a little bit of details here. So Kyle Tucker, everybody. We've got Kyle Tucker Group. I love it. We are actually rebranding right now and launching a new team called the Tucker Group within Utah. And primarily focused on just providing massive value to the marketplace and being kind of I don't know, gathering the one percenters of agents out there. I tend to feel that 1 to 5% of agents do a great job. And the rest are just kind of there. So we're trying to get them together and really crush it out in Utah. So right there, it says top agent. I don't know, out of 28,000, we've been in the top 25 or 50 year after year after year. And then, a pioneer and founder of Zen Coast back when it all started with Calvin and Jenny. And it's been an incredible adventure. And a couple other small things is I own a management company as well. We're over 100 units management right now. It's probably about I'd say we're probably at 30 to 40 million under management. And then I own personally maybe 20-ish million in real estate. So 370 doors is what the ownership count is. So that's my background. I'm excited to talk about this topic today. Calvin, back to you.
Yeah, yes, sir. And for those who don't know me, Calvin Chin. So principal of Zen Capital. That's our investing arm, but we run a bunch of investing companies in real estate, of course, being Capital Group, meaning our multifamily development one. We've got $88 million in assets under management, which sounds a lot fancier than it is. Just means that we have $88 million in real estate value. About, I'd say 38 of that million is actually personally mine. But we also have a property management group as well. We manage all these bad boys, which is always fun. And we'll talk about that here in a second. As well as our nonprofits that we run for financial education for kids and our university, which I know a lot of y'all are part of. So one of the big things that Kyle and I share a passion of is sharing knowledge and data. And, I think selfishly for us, this is all new territory for all of us, right? So, we're going to share a lot of things that we think are happening, and kind of are both very data-driven people. So we love numbers. We're very analytical on that aspect of it. I think that's the only way to go. So with that being said, let's just jump in, and hopefully you guys have a lot of questions. Please, if it pertains to it, just raise your hand if you have a question. If it pertains to what we're talking about right there, we'll jump in there. But at the end, promise you guys, we're going to have a bunch of time just for Q&A, and I want most of this time to be Q&A and stuff, but I wanted to start off with just a frame of data. So data. What are we talk about today? Data, right? Fed drop rates. We've been, I think, talking about this for a super, super long time. It's the first time that they're doing this in a while, so it's pretty awesome, right? And I think if you're like a lot of people I've talked to, they're like, great, like the news is talking about rates dropping, like I should invest, but what do I actually do, right? And I think investing, in my opinion, is 90% analytical, 10% emotional, versus I think when we buy our personal homes, it's the opposite, right? It's 90% emotional, 10% analytical, right? So it's a little bit different of a beast. So we want to make data-driven decisions. We want to talk about data first, so everyone has the information. And then we're going to talk about what we are doing ourselves to prepare, right? So we'll go open kimono, as I like to say, just share it all. So let's talk about it, guys. So what happened? That dropped rates. 50 basis points. So who here knows what the two jobs of the Fed is? Like, what are they responsible for? Muhan, I knew you were going to raise your hand, but
It's like promoting economic growth and maintaining stable prices, right?
Yeah, exactly. So if we were to define that even more so, right, it's control inflation, right, and control employment, right? And so that's our two jobs. And I'd say when they started to even start raising the interest rates, this is what, like 22 years ago or so, they kind of told everyone, hey, like we're choosing inflation over employment right now, right? Because they went so fast. I think the fastest raise in the history, right? And it makes sense because at the time, inflation was like at like 9% or something like that, 9.4%, which is the highest it's been since like 08, 09, right? And so, they were telling everyone, hey, right now inflation is out of control and we need to stabilize that first. And the job market comes secondary right now. Fast forward now, right? Higher rates, money just gets more expensive. It tells people what? It tells people that they need to slow down. It tells businesses that they need to stop hiring, maybe cut people. And that doesn't happen right away, right? It doesn't happen like, hey, they raise rates and all of a sudden people start firing people and all that stuff, right? It's a lag effect, right? And we're seeing that even right now. It's not like because they cut rates on, Wednesday or Tuesday, whatever it was, that, the real estate market's going to flood with a bunch of people. No, it still takes a little bit of time for it to actually hit the market. And so I think the expectation for people is that people always think, oh yeah, it's gonna, the market will reflect a lot faster and then it'll recover a lot faster. That's why I think everyone was talking last year that in Q1, Kyle, I remember that Q1, everyone's like, oh yeah, they're gonna cut rates in like March of last year. I remember that. Everyone's like, oh yeah, I'm just gonna wait until June of 2023, then I'm gonna refi all that stuff. And it just never happened, and it never happened, and it never happened. Then it was Q4 last year, then it was Q1 of this year, and now it's finally happening, right? So there's that lag effect. So yeah, you want to add something to that, Kyle?
No, I just very, very real process there. I bought stuff all along the way, waiting and waiting and waiting, and now I think it's celebratory we're here, and it also doesn't mean it changes overnight. We still have a journey ahead. So but I'm glad we're at least at this point. So
yeah. And personal opinion here was, hey, they raised so fast that if they started cutting really fast, I felt like that would just counteract everything that they did. So I was in the huge camp of 25 basis points max, like very wishful thinking if everyone thinks otherwise. And they chose 50. And I don't know, I was freaking shocked. I was like, holy crap, like I can't believe that they chose 50. And it's interesting, right? So I started doing a lot of digging, like I'm sure all you did too. Right now inflation is manageable. It's in the 2.5% range, which is solid. I think their mandate is 2%, which is great. But I think, and at the most point, if you just look at it on the surface, the job market also looked amazing. I think, we're at like 4.2% unemployment, which is like, oh, that looks great. Like, on the surface of it. So, it's like, oh, is it mission success, for a soft landing and no recession, right? Like, I think that's what people are trying to say, but let's pump the brakes there and let's just say not yet, right? Maybe, but maybe not, right? And so one thing I want to just point out to people that I kind of found during my research is, yes, unemployment is 4.2%. Not bad at all on the surface. But one thing that they keep on looking at and revising is how many jobs are actually being introduced in the market. And that number has gone down every month. Oh, actually, crap, we forgot that we missed a bunch of jobs that actually didn't get added. Our bad. So it really made the numbers look better than it was, for months at a time. And what that means is like, yeah, like, the Fed is saying that, yeah, it just shows that businesses just didn't really have an appetite for hiring people and growing right now. I live in the Bay Area, California. Our biggest industry is tech. No company right now is like, oh, we're hiring a bunch of people. It's the opposite. I got a lot of friends are like, oh, I'm out of a job. I'm worried I'm gonna get laid off. My sister was a recruiter for tech back in the day. Guess what? Like all her friends don't have jobs, right? And herself at the time, right? And so again, lag effects of that. So I pulled some data and actually found like, what jobs are actually there, right? And if you look at this, so 4.2% unemployment rate, pretty good. I think 0809 again was like a lot more. It's like double digit percentiles. So if you actually look at where the jobs are right now, it's, you could see, tech, professional business services, negative, 358,000 jobs, right? So construction even lost jobs, manufacturing, transportation, everything. The two and a half industries that actually gained jobs was health, other services, whatever the heck that means, and the government, right? And I think the government actually jobs here is actually a little lower than I think it actually is, but what that tells us is okay, the Fed is actually transitioning from, okay, crap, we were going hard to battle inflation. They got that down, and crap, we kind of forgot about the job stuff and the data. They were making data-driven decisions on bad data. Right? I think Powell even said that, and now they're like, crap. Okay, we got to reverse courses, which is, I think, part of the reason, if not a big reason, of why they're going 50 basis points too, right? Because because the more expensive money is, and that is what interest rates does. The more expensive money is in general, right? So businesses can't grow as fast and all that stuff as well. They can't hire people. It's more expensive to do business in general.
Yeah. So one thing for you guys, just to double click on what Calvin just said, so it's super clear if y'all haven't been following, as the federal government, and as they've been monitoring the macro situation on what to do, they've been using information to make decisions. This year is when we started to see some instances where they're like, that, essentially they came out and said that like the information we had when we made the decision in X month, we didn't, I don't have the exact data, but call it March, call it May. They're saying that they have to restate their numbers. And so the situation was maybe a little more bleak than what they had thought at the time, because they just kept holding the line. They kept raising the rates. They kept on going. And so now there's just a little bit of this appearance of like, oh, well, if stuff's it was essentially stated in a way that made it look like we needed to continue to tighten a little bit more than we needed to. So the question that is in the air that we don't really have an answer to today is, where are we really, right? And where do we go from here, right? And so that's some of the things, just so everyone's really clear, is the government will continue to re-go through their data and be like, is it really the way it should be? Because from a macro perspective, you guys, they are steering the overall economic state of the United States, which is a huge, huge job. You want to be as accurate as possible. And if you find out at all that the decisions you were making was off of something that was inaccurate, you're going to want to try to get as much accuracy as possible and maybe reassess your decision making, right? So just want to be super clear on that. And that's where Calvin's mentioning, they knew they were getting to those rate drops, but maybe they were just slightly a little more aggressive than the original anticipation because of the discovery of some of this bad data. So just to kind of restate that. So
yeah, I love it. And like I mean, I've been a person that's done this as well, where we're making decisions on bad data before, and you're like, why is things not working? Why are things not getting fixed? Oh, because the data's bad, right? And so it's not a fault by any of them, but more bad data. So another piece of data I wanted to point out, because I thought was really interesting as well, was, so here's a chart that kind of shows consumer spending versus inflation. And so we're actually at all-time highs in consumer spending, which I thought was so interesting, right? Because inflation's going up, right? But spending's going up too. So again, I kind of look at this as a positive sign, indicative of like the mentality people have about what the economy is like in general. Because let's be real, a lot of this is psychological. But what this tells me is that, what this tells me is that people are not afraid to spend still. And I think I think it was like 2021 when people were printing money, savings were at the highest it's ever been. Now it's at the lowest now. So we're kind of a reverse course again. So again, we're in a capitalist society. How GDP works is just trade, consumerism, right? All that stuff. And America's really good at that. And this kind of just shows that even with higher inflation, people are still spending money, which is good, but just an interesting factor that people are still spending money, even though inflation is going up and even though savings are at an all-time low. Cool. Who here knows what the dot plot is of the Fed? So the dot plot is something that's super cool. They basically take a survey for all the Fed chairs or all the people that are on the Fed board, and they kind of give their idea of where they would want rates to be in the future. So they do this every Fed meeting, right? And so based off this, you can see, I mean, it's really small. I don't know if you guys can read it or not, but this is kind of a predictor. So every dot represents a member of the Fed, right? And they kind of put their dot plot of like, where do you think rates should be by this time frame, right? So you see 2024, you see 2025 and all that stuff and so forth. So based on this, I mean, majority of the members believe that there's still another 25 to 50 basis points to go of cutting this year. Two think they're going to stay. One person thinks they're going to drop 75 basis points. Good for that guy. He must be in real estate. But everyone else must be in the middle, right? Of like, all right, we think 25 to 50 basis points. So what that means is, this is just a start. And you can see a trend is that like most people are thinking, 2025, it's a whole nother basis point by then. And then by 26, 27, 28 is more stable, right? Where it's going to stay at. So that's just that, and they are making decisions at the end of the day, right? So it's like, it's on them. It's not the president or whatever. So this election doesn't even matter. The Fed does it by the Fed. They're independent from any other political party, whatever it is, right? So obviously, I think, Joe, you mentioned this. Yeah, the rate cut baked in. It was already baked into the rates in general. So you saw rates drop to 6. Again, that's going to continue to happen. What this just means is, as investors, we're happy, but the rate coming down 50 basis points doesn't change the game, right? Maybe it opens up a small amount of deals, but if the deal wasn't working, at 6.5, is it really working at 6.09? I don't know. I mean, that shouldn't be that big of a decision making for you in general, but it is it's a start, right? What this is telling me is more, it's a start of the rate cut cycle where they're going to continue to do this, looking at the dot plot as well, it's going to be a trend that's going to happen and happen and happen more and more and more, which means that we're probably going to get more confidence from investors again, from even sellers to actually sell, as stuff comes down more and more.
Yeah, and I'll throw something in here too. So super important, everybody. If this is not clear, this is very simple. It's very simple, but I want to make sure everybody that's interacting with our communities and coast, anybody out there, just make sure it's very, very clear. The rate that the Fed is controlling is not mortgage rates, you guys. Like that's just a super important to understand. There's a relationship there, but it's not a direct, it's not the Fed's dropping rates, so mortgage rates go down. What's interesting, if you see on this chart here where these spikes are, and then you see those downhill trends, that's when the information or the news broke that we were going to drop rates, right? And so a lot of times, so you guys kind of have context is like, that's where, as Joe's mentioning in the chat, hey, they're already baked in. Well, we knew the drop was coming. And so the market starts to respond of like, okay, money's going to get cheaper. So the market kind of responds. So the reality is we're finally in that trajectory of the money, air quotes, like getting cheaper, right? But it's going to take time for it to get, call it fully cheap, I guess. And so we want to continue to see this kind of, play out over the next 2 years as money gets cheaper. There's that lag effect of it actually cycling into the economy, and businesses are like, I'm actually going to take on a loan and invest and grow right now versus I'm just back down the hatches and like trying to like keep the water on here, right? And so you'll start to see that ripple effect. And so the mortgage rates have some of the relationship built into them, but just want to make sure that's super clear on everybody. We'll probably have questions about mortgage rates because this is a real estate community. We'll talk about that here in a bit. But it is something that we are excited about, and we're excited to see the mortgage rates finally. They've kind of gone on their trends, and there's been some downs, but there hasn't been that moment of like, we expect to be in a downward trend. It's been like hiccupy in an upward trend. And now I think we'll see some hiccupy in a downward trend. Right. So
yeah, ups and down. And something that would be really interesting to track is, does inflation go up now as well? It probably does. Like, I think the biggest driver actually is housing. And Powell didn't really have a great answer when asked that about, hey, what do you think about housing? He's like, yeah, consumer spending, is going up, but like all the other stuff's kind of going down, which is nice. But housing, we need more supply. And I think interesting enough, this actually opens up more supply because it's counterintuitive, right? But the lower interest rates, I mean, right now there's such trapped interest, there's trapped equity because of 3% rates that we had, and people were like, I'm not going to refi, I'm not going to sell, right? I'm stuck in those games. So many of those properties that I don't know exactly, I think it's like 40%, it's like less than 44% rates right now. So yeah, there's like that huge supply that's stuck there that people are not going to touch unless it's getting closer again, right? And even though they have equity in there, right? So that'd be interesting to see as an indicator as well as inflation. Okay.
Now I'll add to that real quick. Just like everybody listening, that's huge to realize like that stuck equity, because when we're saying, hey, we're in a downward trend, well, there's no crystal ball on this. It's just like a nice smooth on our way down. Like, depending on the speed of it, depending on like if people start to unlock that equity, does that mean a bunch of money floods the market, which then causes inflation to go up, which causes the feds to kind of re-gauge their pace, and we drag things out longer, which could readjust as well, right? There's still some finesse that's going to be required here, but it's really interesting to be at a time with, and I don't know if this is a fact, but from my understanding, we're at a point where there's probably more stuck equity than there's ever been due to what happened during COVID and how much money came into markets and how much everything went up in value. But then a lot of that money hasn't moved quite yet. So there is very much is a cognitive reality of like the next period of like, the Fed has to be really careful to not unlock that money too quick, or else we're just going to undo what we've done and so on and so forth, right? So there's a balance here.
Yeah. I love that. And kind of segue away into this of supply and demand, right? So it's funny because, a lot of talks happen like, oh, is interest rates going down? All right, everyone's going to jump back in. Like it's a sure thing. I mean, let's be real, guys. Like, no one freaking knows, right? We can only make, is a best data-driven decision that we can. And I think the only thing that I found to be constant is that if you hear it in the media, it's probably not true, right? You kind of just adjust along the way, right? And I remember when I was, I was a business major. I went to Cal Poly. And I used to joke about my engineer friends that about what we were learning about, right? And I remember my engineer friends, they would talk about formulas and spaceships and blah, 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 right? And they would say, hey, what do you learn in business class? And I'd say, well, I learned about supply and demand, right? And that's how real estate works, right? It's legitimately just supply and demand. And, when prices go up, right, there's more pressure, right? And when supply, when demand, there's more demand for properties and there's, a fixed amount of supply, then prices go up because there's more pressure. When there's more supply, right, than demand, then there's less pressure. Prices go down. It's that simple, right? Now rates, and why it is important, why we're even talking about this today is that rates are just a mechanism, if you will, that really just has an effect on the outcome, which is supply or demand and demand, right? And so the higher rates, right, means that, it meant at least that deals just cash flow less because as an investor, yeah, you have higher rates, you have more of a mortgage, you can't, you're not going to cash flow as much. Demand goes down from a lot of investors. Now, supply and there's a lot of supply in a lot of markets. And, it's because, debt has gotten really cheap from the years before, right? And so rates coming down now, what that does is it's going to add more demand again, right? And potentially more supply, like we just talked about, right? Like, okay, is it unlocking a lot of people that can refi now or are okay to sell at a 5.5% rate now versus they had a 4% rate. It also means construction is going to be more as well because there was a lot more construction. You can see here in the graph too. In 2021, when the rates were low, construction boomed a little bit. But when they started raising rates in 2023, that came down because it got really expensive to do construction loans in general. So more construction, the more development means that you're gonna have more supply again, right? It also means that there's gonna be less credit card debt, right? Less auto debt for people. So instead of having 20% APR rates, maybe that goes down a little bit. I'm not gonna say it goes down to 0% like it was before, but it goes down a little bit, right? So people can actually save more money again, build back their savings that has been depleted this last year. And you can see the spread data here. This is all the housing starts in the future. Again, I'll also say that every market is local, especially in real estate. So do your research. You can find these housing starts on the county websites or on the census website as well. Super important, right? Because I'll put it this way, like in Austin, Texas has a lot of supply right now. Nashville, Tennessee has a lot of supply on the market right now because a lot of people did build in 2021 and stuff like that. So rents have gone down, prices have gone down, right? I think Austin's down 35% since peak. California, where I live, yeah, you can't build here for crap, right? So supply stayed fixed the whole time, right? So really big metric to look at right now is that metric, and depending on what your exit strategy is, should help you determine like what market is best for you, right? If you're long-term hold, then you're good to go. But if something else, if flipping wise, like that might not be a great place to start as Austin right now. Cool. All right, cool. So let's talk about what are we doing. Well, I'll tell you this much, right? Here's a graph of the median home price in America over since 1963 or something like that. We're doing exactly the same thing that we were doing before. We buy long-term, we're long-term buy and hold people no matter what. So all this talk about interest rates, yes, it does affect cash flow in the present. It does affect how many deals that actually work and pencil for us. It did make it harder when rates were higher, for sure. But at the end of the day, like our strategy is that we still look for cash flow positive deals in today's market that we can still add value and build more equity in the future. Right. And that doesn't change, right? Because like what we're talking about with these interest rates going up and down and prices going up and down. I mean, it's very minute if you look at the graph here. I mean, if you look at the graph here, like, yes, maybe if I buy in, 2009 at the low, my high, in 2021, I'm making a crap ton of money. But if I bought in 2015 at that perceived high, I'm still making a lot of money in 2021, right? So like, I know there's a lot of hype around like, oh my God, like here's the time to go in. But like in reality, I mean, real estate is just get in the game and stay in the game, right? And don't get nervous about, a bad market and selling. Because like, if you bought an 05, for example, at the peak right here, right? And you panicked and you got over leveraged and you had to sell in 09 right here. Yeah, that does suck. That's a bad investment. But if you bought an 05 here and you got crushed in the paper equity of stuff and your value went down, right? But you're still cash flowing, and you cash flowed, you still cash flowed, and you held on, you still cash flowed, you still cash flowed, and you still cash flowed, and you still cash flowed. Something happened here, still cash flow went up, and oh my God, another thing happened here, oh my God, and then COVID happened, went down again, but then it went up. You think you're happy about owning real estate here now, when you bought here? Right? So it's all frame of reference of just like, hey guys, if you just do the fundamentals of real estate, just stay in the game, buy real estate, hold it. Like, yes, be educated on the news, but don't panic and don't get over leveraged, right? So you have to sell, then you're going to be all right. And so that's what we're doing. I mean, that's kind of our strategy, is kind of boring, the same. Kyle, you changing anything?
No, not really. Yeah, I mean, we bought and we've continued to buy when there were sales and discounts, and I just think that I'm excited to do some financial restructuring over the next while, several years. But I do know that a good example of this, it's not this a direct curve, but so you guys know, if you're kind of giving Calvin's example there, if you're riding up like that 2005 curve between two recessions there, I've been buying all along the way, right? But more recent times from 2015 and on. And I bought some stuff like right at the peak, right before stuff tanked off, right? Now, investors buy always, right? But the key here is like, back down the hatches and cover the risk while you're in that downward trend so that you can ride it back out, right? So I know exactly which of my units are on the front end of that thing and then which ones are on the back end. And so I know which ones for me have a little higher risk, and I'm making sure to pay attention to those and put extra reserves in for those, just so I can continue to, although the news is fantastic, it's going to take time to fully ripple, right? And so it's not going to be an overnight thing. We're still a ways out till, I'll just say that we're a ways out before I refinance everything for a permanent 30 years. But I've got to get there. And so my higher risk stuff, I'm ready to cover and keep going. So
Yeah, I love it. And so let's talk about how we can prepare, right? So Joe, you mentioned something in the chat right there. I love it, right? So yeah, Airbnb is starting to go delinquent. Huge surge in foreclosures in that aspect of it. People got over leveraged there, 100%, right? So definitely think there's gonna be a lot of deals in general coming out right now. I mean, we do a lot of multifamily, for example. I mean, a lot of bridge debt was out there. A lot of operators were holding on, waiting for that Q1 2023 refinance that they could do because rates were going to drop. Didn't hit. Banks were getting crazy about it. They were extending them, but now the banks are over it, right? The banks were getting crushed too. And so now they're like, okay, like we've seen a lot of these deals come to fruition lately, is that in multifamily at least, is that, yeah, people just can't hold on anymore, right? Investors need their capital, right? And so they're selling at basis, right? Or even at the mortgage or at the loan amount. Equity wiped out, bank doesn't want it, who wants it? Or people are trying to save other deals, right? They're saying, hey, cool, we got this other deal that we've had for a while. We have a bad deal here. We're going to sell our good deal that we've owned for a while just to save that bad deal and capitalize it on a refinance. So we're seeing a lot of that. Joe, like you said, the Airbnbs, I think like everyone in my grandma had an Airbnb, right? In the last couple of years. And so I think people were forgetting the fundamentals there too. And Kyle knows this. We talk about this in our community a lot. It's like, hey, as an Airbnb, great, do it. As long as that worst case scenario, it still works as a long-term till, because if it works long-term, you're going to be insulated, right, from a high or low of this, right? And if we do look at, all the stuff that may be happening, I mean, we're seeing the job market kind of deteriorate, and maybe there's a 12 to 18 month window where, it's going to be pretty rough out there for jobs. Does that mean a lot of people are going to be traveling still for Airbnb? Maybe, maybe not, right? So there's definitely some exposure there in the Airbnb market. And if you're banking on all that stuff, it is a lot of exposure. So I agree with that. Kyle, what about you? What are you seeing in residential out in Utah?
yeah, I think there's a couple things I think I'll share, but one of the things is being as involved as I am, I did see my first deal over the last few months that have some concerns, where this deal was someone who bought super high rate, was just going to ride it. Their finances were too tight, and they were begging someone to take it. And they took over $50,000 haircut. Ultimately, they were willing to walk away, trying to kind of get out of the deal at what their loan was, but all their down payment money just evaporated to nothing. and they couldn't hold on. They couldn't hold on. This is someone that I came in and the negotiation I got to was a seller finance 0% down to just take it from them.
Wow.
And like that shows there are some people that just didn't do it right. And they didn't protect themselves. And that's where, in the community, we talk a lot about there's nothing wrong with a little leverage. There's nothing wrong with getting in position as long as we're hedging our risk and making sure we have the reserves, the protections, and all those things. So we don't get caught in a bad spot on that downward spot. And so that's one thing. Another thing I'll say is I'm due right now on $2-3 million notes that are they're blanket loans, so they cover many different properties, and it's really fascinating because we're working through it, but it's costing us a lot of money because the standard terms that we would refinance rates are still higher than when we did those loans originally, and the banks are like, hey, those ratios are out of what we want to lend on, and I'm like, it freaking cash flows, and we're only levered like it's like a 60% loan to value on the property, so we're tons of equity. So we're trying to navigate how to kind of get through those deals, but it's shocking that, guys, I have good deals that banks are even still like, well, cut and dry on these numbers. They're not even willing to play ball and be flexible. And so we're having to find other banks, or we're having to bring additional capital to the table to make sure we can stay financed. So what Calvin's getting at is there are people that will run into that scenario and don't have that response or that protection to cover. And that's when stuff's going to hit. That's like people are bailing out of deals that, I already know of somebody. Actually, there's another one. Yeah, Calvin, there's another one. I know of someone who's developing a piece of land right now where the original developers went bankrupt because they couldn't get things going, right? So kind of interesting. I'm not a doom and gloom guy. I don't think we're there, but there are people that got a little too excited. And so the question is, how can we, all of us here, be in position to potentially, be the bailout of some one of those deals and get a sweet opportunity, right?
Yeah, 100%. And I love the comments in here picking on the banks. Yeah, man, the banks, dude. Yeah, screw the banks. No, I'm kidding. But the banks are, I mean, they're a great resource in this. And Kevin, you asked like, hey, where do we find all these cheap delinquent deals? That's a bajillion dollar question right there. I love that question. They're everywhere, right? Meaning that like, there are things that you have to do to prepare to be in position to find these deals, right? So what we're doing, I'm talking to every broker like every day. I'm talking to all my top brokers every day, right? Because they're the ones at least say that legitimately have the deals, and they're talking to all these people. They're talking to the operators that are in trouble, right? So they're one of the places that we're looking at like crazy. Banks, we're talking to banks as well because Muhan got to put the butt on the joke of banks again, but yeah, I mean, banks, they don't want to be landlords either, right? So, Kyle's situation that people are trying to sell out their loan amount. Yeah, I mean, like, so in 2008, 2009, right, a lot of people lost their shoes because their deals, one, didn't cash flow, but two, was lower value than the actual mortgage itself. So if they even did sell on the open market, that seller would have to write a fat check, right? And so they're like, screw that. I'm just going to sell it, or I'm not going to sell it. I'm just going to let the bank take it. They can foreclose on me. I'll have a foreclosure on my record, but I'm not going to pay you 200 grand, right? And so we're not there yet. And I don't think we will get there, especially with rates coming down right now. But what I'm trying to say is that the banks don't want to be freaking property managers.
Mm-hmm.
Right? So, what we've been doing is talking to a lot of the local banks. JP Morgan Chase, yeah, good luck with them. But like, go talk to like your credit unions in the area and just talk to the managers there and say like, hey, cool, like what loans do you guys have in default right now? And we're great operators. We do this a lot. I'd love to be your first call, right? If you got to have to make moves on that deal, right? And so that's another thing we're doing. We're networking like crazy. So talking to a bajillion other investors as well. Some investors may have deals themselves. They're like, crap, I'm in trouble, right? I just need someone to come in and take this. I've had people do that to us all the time, like especially lately. People also know people. Right? Everyone on this call probably knows someone that may be in trouble on one of their deals. Right? I think the other thing, guys, is getting capital together, right? Like, I think that's one thing I've noticed lately. The last couple of raises we've had has been a lot harder, right? Because of what? That savings rate's going down, right? People are fearful of their jobs, right? So getting capital right now is harder than ever. So yeah, you can find the deal that's half of it, but if you do need to raise capital, okay, that's another beast in itself right now. right? Gone are the days where you could just, call 5 of your friends. They all have, $1 million of liquid and you just do a deal. Now it's like, oh crap, like everyone's, kind of lower and lower. So you got to really network like crazy to one, find deals, but also be able to get the capital stack to, actually execute on those deals.
Perfect.
Yeah. Cool. So that being said, that's all I had on terms of the data. I hope your eyes aren't cross-eyed right now from looking at all these charts and stuff. But Fred source data, Redfin data, always great. I always like looking at that kind of stuff, just to kind of see where markets are, especially local markets. You can look at Redfin data and see like, all right, how's Austin, Texas doing? How's Nashville, Tennessee doing? How much supply do they have according to the low in 2021 and even pre-COVID and stuff too. So cool. I'm going to open it up for just Q&A and questions, and love to talk strategy, talk shop, and brainstorm together, guys. So who's got questions? Or we just hanging out on a Friday? You guys were bored, done with happy hour, and just want to just hang with us.
Beer in one hand, listening to the Fed meeting in the other.
Yeah, listen to Jerome on the other hand. I guess, Kyle, I'll ask you a question then, right? So I guess, from your perspective, are you doing anything, different right now to prepare in terms of capital, in terms of network? What are you exactly doing?
Yeah, that's a good question. So I mentioned a little bit before, I think I'm a little more unique, but I will share what I'm doing. I'm unique because I have a pretty large exposure from a portfolio standpoint. And so I'm really looking for some strong restructuring over the next, whatever it might be. And so looking to kind of, I've picked up deals that I have felt were good. I didn't just, go out and buy anything over the last couple of years, but we really try to maximize discounts, maximize positions, maximize anything that we'll be looking for some restructuring in regards to that. And so part of that, the reason why I say that is in the meantime, I'm going to be able to be putting more cash together, right? And looking and listening for where is a deal good enough? That one I just brought up, and Calvin kind of finished that story on that, where I said someone's willing to walk away from their entire down payment. Just so you guys know, on this story is we were going to sell or find and take it. We ended up not doing it because we even felt like maybe it's a little much. We waited a couple months. They still hadn't sold, so we came back to the table. They ended up getting so not thrilled about their deal that they didn't want even a seller fi because they didn't even want to like still be tied to it. And from what we were told is they had allocated 20 to 30K to go towards the losses of paying off the loan to step away. And so they were willing to sell on market for 20 to 30 grand less than their current loan amount, which was like 100K from when they bought it. So, you're kind of looking for like, where are people super, super in pain, right? And those are the deals that could really line up to be something where, again, that you want to make sure, or we all want to make sure, I want to make sure that I'm covered and I've got myself protected if I go into a deal that's already in trouble. But then I can really navigate getting it out of that trouble over time, because time's what we need, guys. If you can ride something for 3, 4, 5 years, it's a long time, right? Go back 2.5 years from now, real estate was popping, right? And then we've gone through this huge drought, and I think 2.5 years, we'll have a very different conversation right here, right? So I think for me, it's restructuring what I have and, harboring cash to make sure I'm getting on deals that really feel like people are in pain. So definitely not buying like your average deal, waiting for that good stuff to come across the plate, because I think it has and it will.
Yeah, and something I'll throw to Kyle's thing too, because I know Kyle well. It's like he's in a lot of creative financing deals this last couple of years. A lot of seller financing deals, $0 down, super cheap rates on the seller finance kind of thing. So that's another way too. I will say, like, what I think psychologically this is happening is I got an unsolicited offer on my properties yesterday for like way more than it's worth. And I'm like, holy crap. So what that tells me is like there's probably more confidence in the market again, just on that. And all that we're talking about, guys, these are all good stuff for this community right here as investors. It's amazing for us, right? Like I'm super stoked because we've been waiting for this forever, right? So I think there's, again, there's probably a little bit of a window here still that you can buy stuff maybe at cheaper stuff that people need to get out of their deals, like Kyle said. I will say one thing, Kevin, to your question too. It's like, honestly, the last few deals that we've done, it's not because they're delinquent or like super distressed. It's actually because their age. People are just, that age is always a impending factor. Like 70 years old or higher. Like the last, like, I want to say like all the deals I've done in the last like 2 years have been because they're 70 years old or higher.
Yeah.
And there's like, I'm retired, I'm done being a landlord, all that stuff. And whatever. I don't want a big fuss out of this. I just want to sell and get it out and then go from there.
Yeah.
So
one other thing I'll add, Calvin, just on my end, and then we've got some hands, so let's get some questions rolling in here. So
yeah.
one of the things I'll say too, and I was having a chat with someone yesterday, was this is going to be a time of movement, like Calvin's saying, aged, right? It's like people kind of wait for cycles, and this is a transitionary point. And so you've got, people have been waiting to enter the market. You've got people waiting that have been waiting to exit the market. Like there's been a lot of holding. I know, and we're not going to get into a political discussion, but this is a year of politics that causes other holding, right? So there's a lot of question marks. So we get a president in seat regardless of what happens, and we get into next year and rates are trending down. It's a very different environment than what we're in or have been this year, right? What does that do? A huge thing, so you guys know, even on my end, I'm actually going pretty heavy in getting some businesses even to a stronger spot. And so I'm even looking, because if there's some buzz and some hype around buying, I will totally take some of my properties and take them on market and sell them to reallocate that into my businesses, right? If that buzz isn't there and the buy is not there, maybe I won't, and I'll continue to hold them, right? So I'm going to gauge my local market on like, how is it going? What are people doing? Is there frenzy? Is there not, right? And so kind of repositioning, look at like return on equity. Could I reposition and look at my opportunity costs elsewhere? So I think to summarize everything up is it's a time of change. And so don't take anything for what it's been. Start to look at things. Where could they go? What are they right now? Do I have the actual data to judge how they are right now? And one thing I will say is, do not get your data from your Apple News article, right? Like if it's there, it's late, right? Or it's some sort of biased opinion in some direction, right? Study data, really get into it, feel the local markets, and it's a time that I think opportunities really could be had.
Yeah. And good thing, I'm going to go to your question first because I love this. I've been meaning to answer this real fast, but you said you're worried about inflation getting higher because of money getting cheaper. Yeah, I agree. I'm worried as well. But guess what? What do I think about that? I think that you should own freaking hard assets if you think inflation is going to go higher, because guess what happens with hard assets and inflation? They go up, right? So yes, I am 100% worried that inflation is going to go up, and I'm 100% pumped that I own real estate because it's got to go up, and I want to own more if it's going to go up, and I think it's going to go up too.
Yep.
So great question, but yeah, I love it. So Addie, my capital raising queen.
Regarding the commercial market, I was wondering, because I'm learning that with commercial loans, they're typically, 5, 7, or 9 years, so shorter term. So how does the rate impact your strategy with multifamily deals? Like, I guess in terms of the long term, like depending on the rate, does your strategy change whether you plan to sell in 5, 7, or 9 years, or would, if you refinance or do something different or hold it long term?
Yeah. Great question, Addie. So yeah, yes and no, right? So obviously the fundamentals are there is like the rate has to work at where you're buying it that day, right? So if it works, in your deal, the rate works for where you're at in that deal and what you have it under contract for. And that should be your judgment for whatever loan term you have it for, 5 years, 7 years, right? And in between the 5 years or 7 years or 10 years, wherever is it a 5 year? It's a 5-year loan, right? On yours? 5?
Yeah, it's 5.
Okay. So in between that 5 years, you have one job, and that job is to get NOI up, right? And you can't worry about what's going to happen in 5 years because you don't know. Rates can be lower. It could be higher. A lot of people bet on lower in 2021, 2022. They underwrote it that way. They got in trouble, right? So the only thing that you can control is get your NOI up in those 5 years. And then, within, I think, about 18 months before your loan is due, you should be looking at what the loan is right there and then, and making that adjustment from there. Like, do I have to sell? Can I refi this? Right. And that's how you make the judgment call on, the rates unknowing where they're going to be in 5 years. Right. So that's why I like the longer terms, right? The longer terms are better because the longer terms you have, the longer you have of the cycle of rates to go up or down. Right. So that's the only job you have though, is get your NOI up. That's the only thing you can't control. And at 18 months forward, you gotta look at where rates are at that point and figure out what the strategy is. To new data points from there.
Okay, can I ask a follow-up question to that?
Sure, absolutely.
How do the rates relate to the cap rates? Do they just trend down as the rates go down?
They do-ish, right? So cap rates are just independent on like, okay, what are people actually buying properties for based off NOI? Now, right now we're seeing a correlation of that. Okay, rates go down, cap rates go down as well. Rates go up, cap rates go up because it's just more affordable to do so, right? Like that's, how much cash flow they can do. That's how much DSCR, bank will loan based off that. You should see somewhat of a correlation of rates going down to cap rates going down. Now, the flip side of that is, okay, what if you're in a situation where, rates go down and the employment market is so bad and wage growth is so bad that actually rents go down because people can't afford stuff, right? Then it wouldn't be a complete correlation, right? It'd be a different correlation there. So it's not just that, it's one factor for sure. It's been the main big factor lately, but now I would say additionally, the employment factor is in there too.
Yeah. One thing I'll add on that too, I think, is just to be aware of on those cap rates, right? When rates got up with that correlation, when rates got up into the 7-8s, right? Like that didn't force caps to be transacting at 8s and 9s and 10s, right? That it wasn't that tightly related. It is, semi-related, but I bring that up because it's not like people were making deals successful at like an 8 or a 9 or a 10 cap. They were still lower caps, or they're looking at a value add or something like that. So I do think there will be that trend of the cap rates going down a little bit with the rates, but it's not that marginal swing from 8 to 4 per se, right? There's only a little bit of room in there. So just be aware of that as well. But yeah, there's a lot of if we could have made it work at that in the past, there would be more movement we would see, but there's just nothing worked for the last 24 months unless you got creative, right? Or value add or something like that. So
yeah, but your deal, I mean, I've seen your deal. It's solid, right? Like it's a great deal in general, right? It's just the capital stack, right? that has to go there. And I think you have room with the cash flow and stuff. But yeah, it's right now it's just network like crazy, have as many conversations as you can, right? Yeah, and just show that, hey, I've done my due diligence on worst case scenario, like you are right now, asking these questions. So,
well, we're even thinking of just not raising the capital for the rehab, because we just may not have enough, and then just going in and then letting everyone know that we plan to rehab, year 2 or 3.
Yeah. Which the numbers are good on that too. Yeah.
Yeah.
Just make sure you have cap reserves. That's all. Cap reserves will save your butt no matter what. And that's baked in the deal. Cool. Aklish.
Hey.
What's up, Aklish?
What's up? I have a quick question on those of us who got in at a high interest rate, especially like conventional loans. So I'm wondering, what is a good strategy for refinancing, the timing of refinancing, since these interest rates are going to keep going down over a pretty long period of time. And you want to save your costs, right? So you want to refinance at some point, maybe once, maybe twice, I don't know, and it costs to refinance also. So just thinking out aloud, like what would be a good strategy to go about the timing of refinancing?
Yeah, I'll let Kyle take this one because I see him itching at it.
because I'm ready to refinance. No, I mean, there's that portion of my portfolio that there was, there was us ultimately. For some of you guys that don't know, some of the acquisitions I made, we actually pre-built in the cost of carrying it. So at that higher rate, we took, a built-in cost and carried it for 24 months, 36 months, 48 months, whatever we did on the deal. And then we anticipate, okay, this is when we plan to refi. And for many of my deals, there's not a single one that's due at this time. They've all still got 2 more years of runway. But that being said, a great question, Akhilesh. And I think those that are in the community talk to each other, pay attention, because it's a math equation on refinancing, right? There's a cost to refinancing, and someone might be like, ooh, I can get X amount lower per month. If it costs $3,000 to do that, it's like, well, my ROI is 3 years, 4 years before I break even on that. And so you don't want to do too much refining over the next 2 years. But if the math is there, you could, but ultimately we're going, and Calvin, I want to hear your opinion on this. From my understanding, we're on a trajectory to get between 4s and 5s. That's what we're ultimately hoping for. And so, like, yeah, I'm all excited that rates on primaries just are tinkering around 6, and maybe investors are, high 6s now instead of 7s. When we get down into the low 5s, we're still not quite there. And for me, at least, and this may not be the same thing for everyone, but it's a pain for me to go through a loan. It's a ton of work. So, like, the same thing will be for a refi. And so, like, I prefer not to prematurely try to get into that conversation. I want to get there to where my calculator was kind of estimated to be at, hit my refinance nice and strong come that time, and then move on. I don't want to play the game, in the meantime. So I think you guys want to get set on this is the final thing I'll say on this, and I'll let Calvin make comment. Get set on your analyzer. You know what you bought it for, you know what you own it for, you know what your rate is. Do a little ARV action where future state is maybe the same value, but then you adjust your rate and say, like, what am I solid at? And I'm going to go towards that. Because what I don't want people in this community doing is trying to time the bottom rates, right? Like, then everyone's going to be all huffing and puffing when it bounces back off, right? It's just like, put your math in and secure your deal and lock in, like, love my deal. I'm going to put a 30-year loan on this thing at this new rate, set it and forget it and move on. If it goes down another 1/8 in the next whatever, so be it, move on, right? Hit the next deal. And so you just want your deals to make sense and be set, because you're going to make more money doing more deals rather than being super fixated on one specific deal. So hopefully that gives some context. Calvin, sure, curious your comments.
Yeah, ditto. No, I think you said it great, man. It's what does the deal work for you at, right? Like, can you hold on to that deal without having to refi? Like, do you have the cash reserves, the cash one right now, right? Like, I'm a big fan of, like, if it's out in front of you and the deal works and you're happy with those returns, go do it, right? And if you're not and you want to wait longer, right, because you're not happy with the returns that you get even at the refi, then wait, right? So very specific to the deal, but again, if it's there, you don't know it's going to be there tomorrow, right? And if it works. So once it starts working for you, Akhilesh, and you like those returns, yeah, do it, rock and roll.
Do it. I think for everybody on this call, think about that, right? If the returns look good and you go lock it in and you're happy, and then it so happens to get even better over the next whatever, it may not. But if it so happens, imagine your emotional state in, even if it doesn't get better or if it does, versus trying to time and you miss it and then you're pissed and then so on and so forth, right? So if you like those numbers, lock it.
Yeah. What if, like, you gotta kiss that? What if you these rates go down a little bit and it goes to like 5, but then inflation goes up and the Fed's like, crap, we messed up, we gotta raise rates again, and you're like, I wanted 4.5, right? You'd be pissed. I'd be pissed. I'd be like, dang it, I got greedy, but I worked at 5. Darn. So, all right, move on. You got a couple questions there. I'll let you take the mic here.
Sure, man. Thanks. Thanks for getting the camera back on. So there's two parts that I've been like digesting, and I really appreciate you guys for putting these numbers together. One is that, like, really with a lot of my friends casually and like semi-professionally, like former colleagues and stuff, we're always trying to figure out, like, what moment in history are we in? Like, is this a good economy? Is this a bad economy? So I really like the angle that you took in terms of looking at job growth in sectors, right? So part one is, like, when you guys come with this position where you're like, hey, the rate cut was actually more than we expected, and that's because they basically looked at some bad data and they corrected. I'm really curious, like, how you were able to understand that. Is that just like what Jerome Powell has said? And then the second portion of it is, this is, like, I guess, more of a subjective experience. I mean, I've seen, so for context for people on the call, I have about 20 doors in Providence, and like it's kind of an interesting like the data point I can offer everyone is I am getting slammed with a $25,000 deletting like work order that has to come. The state of Rhode Island has now passed that every single property that is investor owned has to get a lead certificate. It's very interesting. I have my fund in Ohio, which has 8 doors, and I have Rhode Island. And so it's interesting seeing like the political side go on, right? So Rhode Island has actually passed some of these things. And so talking with my property managers, they're like, listen, like we're shocked by this. It's going to be a huge capital expenditure for investors. But honestly, at the end of the day, like if you're spending this money, there's only one place that's going to come back. It's going to be rents, right? Like, and I've actually told my property managers in Rhode Island, like, hey, if you see investors who don't want to pay the 25K because they're small, small mom and pop, they don't have the timeline. I was just looking up when do the baby boomers retire. It's I really like what you were saying about like, you can't fight demographics. Like help me find these deals. My point is that it's like the capital expenditure, the increases in the rents, the increase in the prices are pretty staggering. Like I'm pretty shocked by some of these new prices that are coming up in Rhode Island. And so I'm curious, just I guess to reinforce from both of your perspectives and what you've seen from the data, are you then potentially forecasting even like larger sticker price growth now that we've cut the rates? So sorry, I know that's 2 big questions, but I'll pass it to you.
Sticker price in terms of the cost of acquisition or rents?
Both.
Both. Yes, right. And okay, so actually, I should take that back. Depends on the market. It's all local, right? So in Rhode Island, you probably don't have a lot of supply right now on the market. And so introducing lower rates, it allows for a little bit more supply, a little more building, delayed building, right? So that won't happen until, 2 years down the road from here. But it'll also increase demand a lot too, right? So in theory, on low supply markets, right? This is my opinion, right? This is what I'm looking at and judging myself on, is that in low supply markets, this and continued rate drops will increase prices because supply is still here, right? The introduction of new supply via refinance will still take months. The reintroduction of supply via development will take years, right? So you're kind of at that point, right? But demand now has ticked a little bit, and it'll keep on ticking every time there's a rate drop, right? So it will put more pressure on that. Same with rents. Let's reverse that into a market that has a lot of supply in the market. So big cities right now are getting crushed. Atlanta, right? That's a big city that's getting crushed right now. Dallas, Nashville, oversupply, right? So supply is here, right? And now rates have dropped. Now people can actually supply a little. And again, it's still here. Demand was here, right? So demand comes up a little bit. So maybe it increases it a little bit, right? But then you got a lag now of these refinances and buildings coming to fruition as well, right? So that's how I look at everything that you just said, right? I like the Fed is the Fed, right? And politics are politics or whatever, right? But they're doing their job for what they're trying to accomplish, right? The Fed is trying to accomplish inflation and unemployment. They don't care about the investors, right? They don't care like, hey, is Calvin making money on investing? They don't care about that, right? Like, in fact, they probably are a little bit opposite of that right now. So I look at like, what are they presenting to me? I watched the whole Jerome Powell like speech after as well, and kind of him getting grilled and stuff. I love that kind of stuff, but because it's like more raw, like you ask more question and Q&A from him. And so I took all that data and I said, as a real estate investor, what did I hear? Right. And I heard that, yes, he doesn't have an answer for housing, right? He's like, hey, yeah, the CPI is 2.5% or whatever it is, but housing, that is the biggest one. We need more supply. It's basically what his answer was. So that's one thing. You mentioned ADU and Kamala housing policy on this. Yeah, I mean, and so again, like places with like blue states, for example, like in my backyard here, where they're so fixed with supply in general, where it's it's so hard to build. Yes, ADUs are getting more and more attractive in general. I forgot this other market I was just talking about with someone that they're just pushing ADUs so hard right now because of supply.
I was shocked to hear that Massachusetts was following California. California's a big market. Like there's your supply, like you guys are, like where goes California, there goes the rest of the country, right? And I was shocked to hear that Massachusetts was on a similar track to imitating your legislation around ADUs. But it's interesting because like even when we were at Sericon talking about like what percentage meaningfully do we think people will be able to execute ADUs, whether it's the financing of them, whether it's the project management, I just completed this $50,000 renovation last year and it kicked my ass. Like the normal American is not able to execute a $400,000 building of an ADU, right? And so it's just mind blowing to see the affordability crisis and the fact that our presidential candidate is like really taking up that one.
But that's where rates come in a little bit right now. I mean, again, 50 basis points isn't going to be a huge thing yet, but if they get to 2 point drops the next 2 years here, starting from now, the end of 2025 is what they are predicting the adopt lot. That does open up a lot, right? Because you said most Americans can't afford a $400,000 ADU conversion, right?
Right.
At the current rates, right? But if they did it at 2 more points down, yeah, maybe that opens up a lot more that could. Not to say everyone, but it opens a lot more that could in general. And then I think there's just like it was North Carolina, actually Durham, that they're just like, yeah, we are low supply. We're just approving anything that is an ADU thing. California is still kind of like, hey, we like ADUs, but you still got to go through our red tape, right, to get it approved, which takes like months and months and months for the permit. So, yeah. Cool. All right. What other questions, guys? We'll take one more. I know we're a little bit over time right now, but we'll take one more before we gotta shoot.
One more. While that question's loading up, a comment I'll make, just something that's interesting as you seek data, learn about some things is Calvin, you've heard him say multiple times on this call, local market, right? It's not, there's aggregate as a whole as a country on how things are going, but also pay attention to what those, local circumstances are. And so something that came to my attention this year, data wise, was actually understanding some information regarding the demographics that own the real estate in certain areas. For example, where is the oldest age in the country, or where is the youngest age in regards to who's living there from an adult perspective? So it's just something to pay attention to when you're looking at markets and opportunities. Is like, we're on a conversation today about rates 100% and what's going to happen there. And there's some big things that'll happen over the next 5, 10, 15 years as generational wealth is going to transition hands. So it's something to be conscious of as we're navigating. So,
yeah, super tsunami. What I do want to mention too, I mean, back to just finding deals in general. I mean, we are all this market data, local stuff. Yeah, it's their baseline, but we are finding the best success right now in this market is in the burbs, the suburbs, right? So not the urban cores, right? Because that's where BlackRock is. That's where all the REITs are in general. That's where they built a bunch of stuff. But where they haven't built a lot is the tertiary markets. 45 minutes, an hour outside of the main core, right? In the city that, you've never heard of, but people that live there heard of because they commute into the city. Like we love those because right now the price points are a lot lower than they are in an urban core, but the rents are like the same, maybe like 5% of a difference, right? But it's like, oh crap, like my rents are up here, but I had to pay this price point for it. It actually cash flows a lot better than urban core where prices are up here and rents are up here too, right? So it doesn't, just something to chew on, guys. It's not like, oh, I'm gonna invest in Dallas, Texas. You don't have to invest in Dallas, Texas. You can invest in Garland. You can invest in Kinney. You can invest in Temple, right? Like there's different areas around those cities that still are more insulated than to the exposure that a lot of these cities are seeing.
agreed. Anybody come up with anything for us to wrap on?
Going once, going twice.
Maybe nothing. I think the one thing to kind of wrap on, Calvin, you can finish up with this. That information came out Wednesday, just some other data points. Like I've even called some banks to see how quickly they modify. We didn't talk about like, when's the car loans less? When's the HELOC less? When's all that happening? Your variable rates are going to change. Stuff will roll out over the next 2 weeks as they adopt, essentially that money that they sweep every night becomes cheaper. So, pay attention to, some tiny bit of lag in regards to that money kind of hitting. And then another thing data wise is the estimate currently is 2 more, I think, if I'm not mistaken, Calvin, 2 more quarter drops by the end of the year. I think they're pacing for a November and December 0.25 basis point drop. So, that being said, you guys, the market kind of reacts to less reality of today and a little bit more to expectations. So if we actually hit 2 quarter point drops, things kind of stay as is because that's what the expectations have been set at. If it gets more severe or less, that's an indicator of what might be going on. So pay attention to the modification and expectations rather than what's actually happening, right? So
Yeah.
kind of just put those data points out there on rates.
Yeah. I'll look at this last comment too is, I think all these investors, all you guys on this call have probably felt the same thing too, where you're like, I'm underwriting a deal. I see it. It's like this close, right? But seller just needs to drop his price this much because I won't be able to cash flow what I need to cash flow to make it work, right? And I have a gut feeling that what's going to happen is that, as rates continue to go down, that price point may not move at all. It's probably fixed at that point, but now your rate's going down. It actually gets to a point where it actually makes sense via the rate that it is, right? So right now, 50 basis point, nothing to cry home to. Nothing's going to change yet. A point? Okay. Now we're talking maybe, like Q4 this year, Q1 next year. Like now we're really starting to move, right, on some stuff. And you get your investment rates down into the 5s. Oh Lord. I mean, I was doing stuff in 2016, 2017 at 5.5, and I was like, stoked. Right. We're getting 5.5 right now in commercial. Residential, we're not there yet, but I think residential is right on its heel to actually get there. So have an amazing time. Great seeing you guys. All right. Take care. Bye.